The broadcast is now starting. All attendees are in
Good morning, good
listen-only
afternoon,
mode.
everyone around the world. How's everyone is doing today? My name is Eric Moreira. I'm the founder of Elliott Wave for gas. And as we always do, several times in a year, we do a seminar for non-members of Elliott Wave for gas for the whole world overall, right? So all the followers and people and traders around the world. So how's everyone is doing today? We're gonna wait about 2, 3 more minutes to allow all the registered participants to be on the seminar. And we're gonna start a seminar that it will be at least, in my view, very interesting, overall. Thank you, Louis, because due to the issues taking place on the market, there is a lot of people that they are a little bit nervous about the market, right? And that's usually the way it works. So we're gonna try our best to explain our view of the market as we always do. We no fear at all, right? Because we in Elliott Wave Forecast, we believe in either be right or wrong, and we are not afraid to be wrong. So eventually, we believe in what we do, either when we're right or wrong, right? So let's give it a couple more minutes before we jump on it and we start the seminar for all, right? All right, so the seminar is gonna have some rules. For example, I'm gonna do early an introduction to Elliott Wave, some simple concepts that that traders need to understand, so you understand my language, and also the rules apply to the idea that you guys are allowed to ask questions. I'm gonna try my best to answer each one of the questions. Most likely during the session, but most likely at the end of the session. If somebody do not agree with my view, it is okay. It is a free world, right? But it's up to you, believe in what I'm saying or not. And like I say, we are not afraid to be wrong if we end in being wrong. That's the way I see it, and that's how it's gonna work. So, but it's gonna be very interesting. My goal is to open so many people's eyes, right? My goal is to open people's eyes and understand that, like you guys see in the screen, the future advance of the indices, the world indices, either it will be a series of 4, 5, or it will be a rally that we have never seen in the history of the indices. So it's a very interesting stage, I can tell you guys that, looking at the overall market from my eyes at least, right? Yeah, the seminar is gonna be recorded, and it's gonna be available to watch in our YouTube channel, which I recommend that you guys all to subscribe to the YouTube channel, where you get a lot of free stuff right there. I mean, daily videos, several videos a month, 20 to 30 videos about instruments. If you are not a subscriber of Elliott Wave Forecast, yeah, it will be posted there on the YouTube channel, without a doubt. Thank you, Gutad. Thank you. All right, so we're going to start in 30 seconds. There is already hundreds of people there. So, but we haven't reached all the registrations. But some people registered, and then for some reasons, they are not attend. But I always like to give a chance, a few minutes at the beginning of the seminar. Thank you, Christopher. Yes. All right, guys. So here we go. Welcome you guys all one more time to be participating in a seminar from Elliott Wave Forecast. As I always say, we are different than most. We believe that Elliott Wave overall is a theory, but we use it more as a language. But there is no question that Elliott Wave has things that can be used to forecast the market. Now, straightforward. If you're gonna trade based in Elliott Wave, go to the casino, guys. You're gambling if you're gonna trade based just in Elliott Wave. Our job in Elliott Wave Forecast since 2005 has been a process which started as a true believer myself of Elliott Wave, in which everything was a detail oriented, still is, but everything was pure Elliott Wave, right? Now, with the years, in doing like we do right now, around 8,000 charts per month a day, which is no secret that we have come to realize that it's no secret that we have come to realize that sometimes what it looks like a 5 weeks in Elliott Wave, the market has to make, the market forces you to make it a 3-way because it's not an absolute theory. In other words, it's something that it was created back in 1930s. And we are almost a century later, and you cannot be using the same concept in a simple 3 rules, right? In trying to reach your capital based on those 3 rules, right? The same way, I can tell you straight out, I don't believe in fundamental trader. I don't even know nothing about fundamental, and I create an Elliott Wave forecasting company, and we're pretty good about it, right? Yeah, you can ask me what is the CPI, and I got an idea, but I don't know how CPI affects the market. You can ask me what is the GDP. I know what is the GDP, but I don't trade based on those because I believe that this market is made by the few and followed by the most. The same way I believe that only the few win and the majority of the traders, unfortunately, ending losing and ending quitting within the first 2 years of trading. That's a fact. That's not something that I'm making it up. That's a fact. So that's who we are. You're going to get a lot of new concepts that you don't get it anywhere. And you're going to get a little bit of Elliott Wave, but it's more everything like we always do an Elliott Wave forecast. It's about common sense. It's about knowing what you're doing. It's about understanding that you are a trader at the mercy of the people that makes the market, and you have no control over. And because you have no control over what the market is gonna do, it's about understanding the possibilities, the path, and figure out what is the path that has the highest probability. Understanding that as a trader, there are different time frames, and that I said that you're gonna win, that you're gonna lose, but you have to have, as a trader, a money management that allow you that when you win more than when you lose, Otherwise, you end up losing. Understanding that the higher the time frame, the better the better chances that you have to win. Because in a century, there is 100 years. In a year, there is 52, 12 months. And in a year, there is 52 weeks. In a year, there is like 200 periods of 4 hours. In a year, there is like 8,000 hours. And in a year, there is like 36,000 periods of 15 minutes. Unfortunately, most traders, they want to be day traders. And those day traders suffer. Why? Because they're trading in the highest number of oscillations, the highest to forecast and to control, because there is something that is called high frequency trading. And the high frequency trading, they are machines that are running ahead of the mind of the human being. Those machines have no fear, no greed, nothing. They execute to perfection. So this is who we are. We have, over these years, implemented a lot of new stuff to the Elliott Wave theory. And that's when you're going to get today a lot of new concepts in this seminar, right? So having said that, open your mind, like I always say. Open your mind right there, as I always say, and you're going to see something that eventually is going to help you tremendously. So say that right here, like I say, the idea of the webinar is to give you guys what is going to happen next, right? To let you guys know if the indices, like some people are calling already, like every single drop in the indices, the war is coming to the end, right? If the indices are going to crash like they did in 2009, 1929, or if the index is going to continue to trade higher in a nest or in a 4 and 9. I'm going to explain to you guys what a 5 weeks advance looks like. I'm going to explain to you guys what is a nest. I'm going to explain to you guys that there are degrees within the market, within the Elliott Wave theory. The degrees, there is nothing more than the time frame that I just mentioned to you guys. That there is a century cycles, grand super cycles. There is yearly cycles, is the super cycles. And there is smaller cycles, middle cycles, and on and on and on. I'm going to explain to you guys a little bit of market correlation, in which I'm going to use something that the Elliott Wave theory do not use. Several times I have seen services, I have seen professional traders being bullish the euro yen and being bearish the euro dollar. I have seen traders being calling the dollar yen to rally or the euro yen to rally and the indices to crash. And they do not understand that doesn't work. A trader without analyzing more than one market is a dead fish in the water. A trader that say, I only trade the S&P is a dead fish in the water. A trader that say, I only trade gold is a dead fish in the water. You cannot trade S&P without knowing what the yen pairs are doing. You cannot trade the gold without knowing what the dollar is doing, right? Because everything is a whole. Everything works together as an oil machine. Now, decoding the oil machine is something else. And that's the system that we have created. And let's be clear. Let's do a disclaimer. We are not perfect. Our system is pretty good. But as a human being, we fail the system that we created. Our system is right 80% of the time. The system. Now, the higher the time frames, the better it is. Now, as an analyst, like at the market right now where we stay. We just finished doing a live session to our members in group one, right? And the analyst there explained to them, I said, listen guys, this is very simple. The market, we've been following a sequence over the last 4 or 5 months, which is a sequence that the market has been following, in which we've been telling them how the market is going to switch from one dynamic to the other. Why it's going to be a period in which the dollar is going to sell, and then the yen pairs is going to rally, and then the index is going to rally. Then after that period, we're going to switch to something that we call it in stage two, that it was another dynamic. And the analyst right there just explained to the members, listen, we're still within the stage three. Within the stage three, there can be two dynamics, a yen dynamic or a US dollar dynamic. If the US dollar dynamic takes place, this is the path that the market is going to follow. And within that dynamic, we might be rolling like we roll in 2020. But there is an alternative view in which this can happen. We don't see it happening yet, but it's a possibility. That's our job. Explain the market to the members and telling them which instrument and which out of the three main elements to the market, which is called the dollar, the indices, and the yen, which one is the safer. Now, as an analyst, we fail sometimes because it's a brain, it's not a computer operating the system. But the system tells you right away when something is fishy or something is running out of the market, right? So we are completely different. And that's, we use a lot of market correlations to locate the different possibilities during the market. And then we're going to give you guys a conclusion in which we're going to let you guys know what is our point of view. Like we told you guys back in 2020 that to buy the dip in the indices, like we told you guys in 2009, like 2009, 2010 to buy the indices with everything. We're gonna tell you what we believe that is coming about the market, right? So the market more or less, the seminar more or less is gonna be about these topics that I just explained it to you guys there. Now, very simple. I don't want to get too much. The seminar is going to last about an hour. I won't get too much in the concept of Elliott Wave, right? And assuming that most of you guys here have an idea about Elliott Wave, right? The basic move in Elliott Wave is presented in that chart. And you guys can ask any question. Don't be afraid. You guys can ask any question. The basic concept of Elliott Wave is presented in that chart right there, right? It say 1, 2, 3, 4, 5. 5 waves in pulse. What are the main rules? That the wave 2 cannot pass the beginning of wave 1. That's the main rule, one of them. Another rule, that in a regular impulse, the wave 4 over here, cannot penetrate the top of wave 1 right here. In other words, this cannot top this, and the other rule is that the wave 3 is the shortest. Now, let me ask you, Gutad, Williams, all you guys there. Don't you guys think that that's too simple to forecast the market and too suggested to forecast the market? Don't you guys think so? Because in my opinion, it is very simple. There is a genius behind the guide. There is a genius behind the guide that developed the theory 100 years ago. Of course, there is genius there. The guys noticed something there, right? But it is too simple. You're risking too much if you're gonna trade just base in that, right? So that's something that you're going to be seeing today in our presentation. The 5 waves advance in Elliott Wave, that's the one to the upside. This is the one to the downside. Now, this is something also very interesting. It's called Elliott Wave extensions. Now, Elliott Wave extensions is say that within the 5 advance with the trend, there is only always one that it gets extended. Sometimes the wave 1, it gets extended, like it's presented in this chart right here. Wave 1 got extended. Wave 3 is the common one, got extended. And wave 5 got extended right here. And then depending on the extensions, the market sometimes trick the traders, because sometimes when you have a wave 1 extended, the traders that use Elliott Wave, they're gonna call a crash, and they're gonna automatically they're gonna call a crash, and they're going to start selling the market over here. When the wave 3 is descending, being the month, and wave 1 extended usually happen in commodities. Wave 3 extension is very common, is the one that happens the most, is the easy one to trade. And the wave 5 extended, for me, is the killer, because I always say one thing about the extensions and about the traders, that traders, unfortunately, and you guys know that better than me, most of the traders, they always late to the party, right? For example, everyone wants to buy gold right now. Nobody wants to buy gold in 2014. Only the good ones bought gold in 2014, right? That's the fact. That's a fact. Everyone wants to buy it now. Everyone wants to buy. They were dying to buy gold or buying to buy the S&P back in 2019, 2020, right? But the good one knew that a correction was coming. So understanding the nature of the wave through market correlation is very important, because it will allow you to know if you are in the presence of an extension in wave 5. Why? Because people that they late to the party, when they see clear 5 waves, guess what? They're gonna sell it. I've seen professional traders from 2009 to 2012, 2014, telling everyone to sell the S&P, that the S&P is gonna go to 200. I've been the same traders selling the S&P with everything in 2020, right? It's because they are not looking at the market correlation. So the extensions, they are killers, because it goes outside of the wave 3 extension, the 1 and the 3, the 1 and the 5, they kill the market, because people start picking the top and they get stopped out in the extensions. So that's what is called an Elliott Wave extension. Everyone understands so far where we're going, right? So we're gonna keep going, and this is another killer. This is what is called a nest. What is a nest? A nest is when you have a series of wave 1, 2, 1, 1, 2, 1, 2, 1, 2. Now, what is the killer here? Is that you got 1, 2, 3, 4, 5, and you start selling, and the market explodes against you. There is a way to identify a nest. And we in Elliott Wave Forecast have created a system that identifies nests, right? And a nest is like I say, 1, 2, 1, 2, 1, 2, with a tremendous advance to come. One of the characteristics on the nest is that you got this low, and this low. In the momentum, it gives you a series of highest high, highest low. Unfortunately, the guy that developed Elliott Wave, which is the one that deserves the credit, which is the guy, Mr. Elliott, he didn't have any tool to gather momentum when he developed the system back on 1930s. He didn't have any tool. So eventually, with the times, we in Elliott Wave Forecast has developed, we have these tools. We have RSI. We have something that we create that is called the distribution system. And these real tools added to the first three rules of Elliott Wave theory allow us to be better forecasting the market. So a nest is very important. Everyone does understand what a nest is, right? Is 1, 2, 1, 2, 1, 2. The same way that you got 3 nests coming out of the lows, you have 3, 4, 3, 4. You see the degree with no parentheses, right? That's 1 degree. With parentheses, that's another degree. So, and with the round, with the cycles, you have 1 cycle, 2 cycles, 3 cycles, 4 cycles, and 5 cycles. 1 parenthesis, 2 parentheses, 3, 4, and 5 with parentheses, right? And the same with no parentheses. Those called degrees. And the same way that there is 3 right here with without parentheses, with parentheses, and with cycles, it has to be a 4 with thou, with parentheses, and with cycle. That's called a nest, right? Everyone understand the concept of nest. Don't be afraid, guys. Ask questions. Everyone understand the concept of nest, right? Everyone understand what a nest is all about, it, right? Yes or no? Beautiful. Beautiful. All right. So the next concept is, like I say, the extensions. I just explained in this slide, which means that the most frequency extension is the wave 3, that the same rules apply for every single impulse, that the extension always happen in the 1, the 3, or the 5, and that the same Fibonacci relation extension sheet is applied to every single extension in the market. That's very clear as we speak, right? Now, another thing that we need to understand are the cycles, right? Are the cycles. And what does the cycles, what do you need to understand to the cycles? To the cycles, you need to understand that for the cycles, you need to understand one thing, which is that the higher the cycle is, the more money you make. Why? Because the higher the cycles is, or are, better say, is less oscillation. And having less oscillation means that your forecast is more reliable. It's very simple, guys. Is many traders, like I say and repeat, they want to be day traders. They want to be in and out in every single month. They want to, the constant say, what do you think is the range of gold today? Who knows? Let's be realistic. A trader, a professional trader, has a mind that he knows reality. He doesn't live in an illusion. I remember doing years and years ago a seminar explaining the reason why traders lose, feel, greed, illusions. That makes you lose because nobody in this planet can know what the market is going to do in the next 8 hours and be sure about it. It's a range. Yeah, you can get the direction, you can know the highest probability, but those type of things in the shortest cycles get more difficult, right? So now, if you told me, Ari, what do you think that gold is going to do in the grand super cycle? I say, gold, I'm going to keep the same thing that I've been saying since 2014. It hasn't changed. That gold is going to go to 2,700 to 3,200 area. I bought gold back in 2014. It hasn't changed. Do you know how many times the Elliott Wave counts that we presenting to members, let's say in the primary count, had changed since 2014 to 2022? If I say 10, 15 times, I would be around the number. Why? Because it's the same, the less probability. It oscillates more. It changes more. So if you told me, Eric, what does the S&P is going to do? I would say to you, it's going to go to 6,000, 7,000, even 9,000, right? It's going to, for sure, it's going to say 6,000, 7,000. Now, how we get there, it can oscillate in many ways. And that's what I want you guys to understand. That's what we hear. Because we in Elliott Wave Forecast, and I know that most of you guys either follow us in YouTube, and if you don't, please go there and follow us. Or you follow us in Stochastic, or you follow us in Twitter, right? Or you, I don't know, or you are subscribed to one of the email lists. That's the way that you guys reach to us, right? So we make an emphasis in Elliott Wave Forecast about the right side of the market. Because I find out as a professional trader that it's better to know what not to do than what to do, right? Because you told me, yeah, the indices. I say, all right. I told the clients every single day. You ask me about the dollar. I say, don't sell the dollar. All right. Don't sell the dollar. This is the area that I like to buy it, right? Now, if it reaches the area, go ahead, buy it. If it doesn't reach the area, you don't lose because you automatically is cutting 50% of the probability because it's all about probability. So the degrees is something that every trader needs to understand, that the higher it is, the better it is, right? But that's why, and the reason that I explain in the degrees is because today we're going to talk about a lot about the grand super cycle, about the super cycle, and about the cycle degrees. We aren't going to say it to you guys what the S&P is going to do next week. We're going to tell you what the S&P should do over the next few years. So you guys understand what is the right side of the market, right? So degrees are very important and needed to understand, right? So before we jump that, we're going to talk today a lot about the S&P. And before we get into that concept, we're going to debate today an historic chart in the S&P that is very popular, right? But it's a chart that it might be misleading many traders, right? I guarantee you that most of you guys have seen a chart of the S&P coming from the 1850s, right? Anyone has seen it? The chart of the S&P 500 coming from the 1850s, right? Have any of you guys seen it? Right? So technically, that chart, this is the history of the S&P. And that chart has made many traders, right, that you guys know, calling a crash, Jason, every time that the S&P dropped. That's the history. In 1816, it was founded a pool, right? Then 1923, it was called Standard Statistics, right there, founded in 1906, SSB. Then started rating the mortgage bond and developed the first stocks in the first stock market in like 233. In 1941, emerged the two companies. And ideally, it was created in March for what do you know today as an S&P 500? It was in 1957, right? Which is Standard and Poor, right? Which is the combination of this with the combination of this. Technically, it went to 500 over here in 1957. So it's the same in some ways that it happens with the euro, right? The euro as a currency started around 1999, I believe, 2000, right? The euro as a currency. Now, I have an historic chart of the euro that is dated back to early 70s. Why? Because it's a combination of the old Germany currencies, and they put the charts together with the euro. You always need to look at those charts with a little bit of because it's not the same, right? You understand what I mean, Jason? It's not the same. This has his own volume. This has his own volume, and this has his own value, right? So that chart that I'm that we're gonna show the charts to you guys, and we're gonna analyze both scenarios, the one from 1860 and the one from 1957, and we're gonna give you guys the most likable outcome, right? Everyone with me so far, right? Everyone with me, I guess, so far, everything is any question, don't feel afraid, just ask, right? Now, let's go and see some charts right now. And we're going to start with the S&P, which is the very famous one, right? We're going to see some charts here. Tell me for a second, and the S&P. All right. This is the chart on the S&P that is coming date back to the 18th and something, right? Eventually, there is a lot of misleading here, right? Who was here trading back? And I ask the question because I know that not many traders last that long, right? Who was here trading back in 2009, 2008? It's 13, 14 years ago. And in the life of the trading, that's a lot, right? That's a lot. Because not many last that long, Christopher, as you know. Who was here trading back then? Anyone? Please. All right, Jason was. Now, Jason, do you recall back then the core people calling that the war is coming to the end, that the grand super cycle ended, and that the S&P it was to around 200 and on and on and on, right? The whole 9 yards that it was called back in 2009, right? You remember that, Christopher Jason, right? Yeah. Exactly. That's my point. I'm going to copy what Jason say to all you guys there. Now, the reason that they were calling that is because they saw 1, 2, 3, 4, 5, 1, 2, and then they were putting this low right here, and they were saying 1, 2, 3, 4, 5, 6, 7, 8, and 9. So at that stage, they can make an Elliott Wave count that it goes like this, right? And you guys gonna notice now how different we are because we never did the call for that, right? Right? At that stage, another good way trading view because I don't use it that much, so allow me little bit of slope in it there. They were calling that right there, and then they have a valid point as an Elliott Wave theory. Back in 1930s, they have a valid point to say, and there was no violation of any rule. It's just the people that most of the people that use Elliott Wave, technically, honestly, they're living in the past, right? Unfortunate. And you guys all need to agree with me. A BMW from 1970 is not the same car that you see that you're getting it right now, right? Everyone agree with me that, right? So, based on the Elliott Wave theory, developed in 1930s, it is valid to say there is nothing wrong to say in 1930 that this is 1, 2 in blue, 1, 2 in red, 3, 4 in red, 5 in red, 3 in blue, 4 in blue, 5 in blue. Right. When they saw this decline, they say, oh my gosh, the grand super cycle ended and this thing goes to new lows. Everyone with me? You see Jason, right? It's valid. I mean, as an Elliott Wave guide, you can say that the grand super cycle ended. The way 5, it was too short, AG, but it nothing say that it needs to be that big because you already have an extension in the wave 3. All you need is a new low, right? No, we don't label truncation in Elliott Wave forecast. We don't do that. It didn't truncate. It makes a new high. I know what a truncation is. We don't label truncations in Elliott Wave forecast, right? We don't. So everyone was calling for something like this, right? At that stage, I'm so bad with trading view, but everyone was calling something that is gonna go this area, right? Everyone was calling that the S&P. For me, truncation doesn't exist, so we don't label truncations. Truncations, giving Mr. Elliott, the benefit of the doubt. Truncation is nothing more. I don't know what's wrong with this, but truncation is nothing more than a way, all right, a way that that Mr. Elliott have to justify right there the flats and things of that nature that it didn't. What do you mean you need to switch the market? Don't worry. You mean this? Let me see if I get it right now. Yeah, maybe yeah. Thank you, Eric. Everyone was calling that back then. And there is no violation of Elliott Wave. 1, 2, 1, 2, 3, 4, 5 in red, 4 and 5. Now, I'm going to start giving you guys how we saw it back then, right? For example, one of the main rules that we apply in Elliott Wave forecast is that the wave 5 always needs to have momentum divergence in relation with the wave 3, unless wave 5 is the standard one. Everyone understand? Remember, Mr. Ariel, Lucas, AG, John, he didn't have an RSI to gather momentum, correct? He didn't have an RSI to gather momentum, correct? We agree, right? In 1930, there was no RSI. RSI was created in the 70s. Everyone with me, right? Everyone see my point? Now, if we analyze this chart right here, when is the highest momentum? The highest momentum is here, right? Yes or no? That's the highest momentum. So this cannot be wave 5 within this cycle, right? Don't be sorry. This cannot be wave 5, Andres. Welcome to the seminar. This cannot be wave 5 of this cycle. So whoever, no, you have an extended wave 5, wave 3, Lucas. So wave 5 is extended, but wave 3 is also extended. Besides, if you do, and I'm sorry, I'm not that good with a, let me see, what is this? Tresman. If I measure the side of wave 3, wave 5 cannot be bigger than wave 3, otherwise an invalidation. But the momentum of this swing from 273 all the way to 2000 is bigger than the momentum of this swing. And that cannot happen. Wave 5 needs to have momentum divergence against wave 3. Right? Everyone agree with me, right? I'm just making a point. So, getting that, if you know what you're doing and you apply an Elliott Wave the correct way, you automatically discount this Elliott Wave view that the peak in 2009 or 2007 was the grand super cycle. Right? The grand super cycle. Right? Then if you make, right here, Christopher, right? No, I don't know. I never use this. Let me remove it. I'm done playing. I use Iseno. So technically, the idea, last chance is not coming right. So the idea that there is a highest momentum here is telling me that 1, 2, 3, 4, 5 in blue is incorrect labeling. Right? Is incorrect labeling. Yes. Good job. Yes. To your question, that it has to have divergence. Right? For example, look at here. 1, 2, 3, 4, and 5. Look at the momentum divergence. You see it there? Look at the momentum divergence. There are always momentum divergences on the wave 5. And the momentum divergence always is against the top of the wave 3. Because if you, or the wave 3 of 3, you got 3 momentum divergence in a 5 waves band. Wave 5 of 3 give you momentum divergence. Wave 5 of the highest cycle give you momentum divergence. And wave 5 of 5 give you momentum divergence like you see it here, right? If you see here, this is the highest peak. But the wave 5 here or this wave 3, this area give you momentum divergency, right? And then the wave 5 here give you momentum divergency. And if you downgrade it from here to here, there will be momentum divergency, not in this time frame, but in the lowest time frame. That's how it works. So my point being is that the idea that 2000 was the highest momentum divergency in the history of the S&P is telling me that this count is incorrect, right? Everyone follow me? It's telling me that this count is incorrect. Everyone understand that, right? So let's keep working this count based in Elliott Wave and the way that it should be labeling, right? The way that it should be labeling based on the RSI. If you don't want to be super aggressive, you label this way. Wave 3 has divergency, yes. Knowing this time frame, there is a tool that we use that is called upgrading and downgrading the RSI, right? All right. So technically, in this stage, you can do the following. You can go this route, but the decline here, it comes, and then you can put, let me see, right here. You can put your wave 4 right here, right? You can put your wave 4, and then at this stage, you are trading within this chart. You got the divergency over here. You got the divergency over here of the wave 5 or wave 3 in red. You follow me? And you already have the divergency. You having the divergency here of the wave 5 in red. Correct? Everyone follow me, right? So in this case, you need to downgrade also and do the following. You go here 1, the Kobe pullback is your wave 2. And now you are working here. You're working here within the wave 3 or 5 with more upside to comes if you're gonna use this decline. And now you see how right here you have no divergency. It's because this advance that we have since 2020 is part of the wave 3 of the wave 5 and discount. This count is gonna keep going higher. At one point, it's gonna end your wave 3 back in the future. Is gonna be another pullback that is gonna break this Elliott Wave channel that been holding 10 there. That's gonna be your wave 4, and the S&P continue to trade higher within the grand super cycle. And it's gonna keep tricking traders at this stage. Now, everyone understand now, right here, and I'm sorry, my limitation, we don't use trading view. I'm sorry, my limitation with trading view, I don't use it. But everyone understand the reasons that I explained, right? The idea that this is the highest momentum is telling me that this needs more upside. Now, you need to understand also the following. Look at the decline in wave 4 right here. Look at the decline in this wave 2. Look at the magnitude. Does the decline in wave 2 in black look similar in magnitude to the wave 4? Yes or no? Indeed, it looks alike. right? The decline in wave 4 in red look in magnitude similar to the wave 2 in red? Indeed, looks alike. Yes or no? Everyone see what I mean, right? You see good time, everyone, AG, they look similar. So, in the market right here, right, that's wrong, Lucas. That's wrong. The idea that wave 2 needs to reach 50% of wave 1, not always the case. Wave 2 or wave 3 always is very shallow, right? That's the idea. When the wave 3 is extended, wave 4 reach around 23.4. When wave 3 is shallow, like a 1.618, wave 4 usually reach 38.02. But in the wave 2, like right here, yes, the first degree, the wave 2 is deeper because the fight between the two sides. But the wave 2 or wave 3 usually shallow, like it happened here and happened here, right? These are rules that we have that is not in the book that you read, which is nothing genius about it. It's a copy and paste of, technically, it's the theory. This is something new, right? Yes, the wave 4 in 2004, Eduardo, it can be a flat. Indeed, that's how we label it. That's how we label it, a flat. I just giving you guys scenarios. That's how we label it, a flat. Our chart, our label, let me do, and if I know how to do this, all right. Let me see. 1 second. Because I'm not savvy with, let me see here, 1 second. And I want to present our charts, our label of this, Eduardo, now that you mention it, right? Allow me a few seconds. Let me see how I can bring these charts out from the scratch here, if you allow me 1 second. I will do it here. And this is how we like it. But the message that I'm trying to present to you guys is very clear, that no matter what, the core for the crash in 2009, the core for the crash in 2009, it was wrong. Everyone understands that the momentum is showing that, right? Everyone understand that? Yes or no? Eduardo, Lucas, everyone, that the momentum is, it wasn't supporting that view. So the way we like it is like this. Now I bring it back, right? The way we like it is like this, right? In which you got 1, 2, the decline in 2009 was a flat, like Eduardo mentioned, and that we're working in the wave 5 of still wave 3, right? And that is gonna make the indices years and years for rallying. In other words, that's what the market is calling. That's what the technical is calling, right? Everyone see my point, right? This is what we call a reset in the RSI. You have right here a divergency that it was erased. This is a wave 3. No question asked. And then you have right here, if you read the swing in the RSI, you have a cycle, a pullback, another channel, a pullback, a low, a highest low, a highest high, and a highest high. It's an impulse. So in our view, the S&P continued to trade within a powerful wave 3, right? In this history chart. Now, I'm going to show everyone any question about this. Clear, right? Any question about this? Clear. William, Eduardo, KK, all you guys there. That's our view, either right or wrong. Super crash ain't going to happen. Right? Now, there is another tool that we use that is called the Stochastic RSI. And something that we have developed is, this is S&P on its signal, SPY to be exactly, but it's the same. So technically, this chart back to 1993. And assuming they started the S&P around here, 1957 some change, right? So in the stochastic RSI, the market moves this way when there is an impulse. And it creates something that is called a snake in the momentum indicator. And a snake, it is something that is called, it's a killer, because most of your brokers makes you believe that when the stochastic reach past the 75%, you're gonna sell. And guess what? Most of the time, it keeps expanding, and the sale never comes, right? Everyone understands that, right? So, and a snake is when the indicator sits at the high. This is 2098. This is the flat. In the other chart, that's what you see here. Is this part over here. Now, is this part over here. You see a word of the flat. Now, let's over here put the stochastic. And look at the stochastic right there. Look at the stochastic right there. That's quarterly. Every time frame is a quarter. So, what do I get out of this? That from 2009, right, we are either nesting 1, 2, 1, 2, because this cannot be wave 4. This decline that we're seeing, it cannot be a wave 4 because there is no reset. Right? Everyone got it? Now look at the RSI. It's showing momentum. If this was wave 4 and the rules that I applied to you, explained to you guys, this peak, it has to be higher than this one. Right? So even if we get back to this chart, this is nesting 1, 2, 1, 2, and this thing is going to explode soon to the outside, even in the historic chart. And the extensions, usually a wave 5 ends, a wave 5 ends at the 618 or 123. I don't know, at the 618 or 123. And that thing comes, I cannot label it here because I don't know, I'm not familiar with this trading view, but it should extend. And when you look at the momentum here, there is momentum divergency in the quarterly chart in this band. Look at how vertical it is, right? Look at how vertical it is. And that we can be in front of the nest, which is 1, 2, 1, 2. So in the storage chart, we might be nesting within, in the storage chart right here, we might be nesting within wave 5 in this degree, with a tremendous advance to come, right? That's what the indicators is saying. This is monthly. You got divergency in the monthly. You downgrade the RSI. This is weekly. You got divergency in the weekly. Wave 3 cannot have divergency with wave 1, right? Everyone follow me? Now, I'm going to ask you a question to you guys. If you guys look over here, the dip in COVID, it is not seen to be found in the yearly chart. You don't see the dip. So wave 4, the COVID dip cannot be wave 4 in red. Everyone understand? I'm just making points, valid points in the technical trading. Everyone follow me? I'm just making valid points in the technical trading. The dip in COVID, yes, you can see the dip here on, you can see the dip here on the monthly chart. But in the grand super cycle, you don't see the dip, because if it was the 4 in blue, look at the magnitude of the previous leg. It takes years. Everyone follow me? It takes years. So I have momentum divergency, right? Everyone got my point? This is the super net. Thank you, Sherby. I tried my best. This is the deepest that you ever seen Elliott Wave explaining. I guarantee you that. Otherwise, shoot it to us. I give you Elliott Wave forecast for free. That's how confident we are in what we do, right? You never seen nobody explain the market like this, Sherby. Don't you agree? You never seen that. Because this is not Elliott Wave like in 1930s. This is Elliott Wave 2022. It's different. So over here, what happens? I have two possibilities based on the two charts. Either if we're gonna label the S&P for 1957, this thing is nesting, and you got 1, 2, 1, 2, 1, 2. Then the S&P is gonna stand higher in a super nest. In other words, if we get back to what a nest looks like over here, if we get back to what a nest looks like over here, and we put it there, right now, we are right here. If we're gonna label the S&P from 1957. Everyone follow me, Eduardo? Shelby, Christopher, KK, everyone. Now, let me see if you guys are a good student, right? Let me see if you guys are a good student. Everyone understands that if we label the S&P from 1957, which is when the S&P 500 was created, we are in the super nest, and nothing here invalidates the nest. You got a higher high, a lowest low. You got here a high with divergency. Look at the divergency there, and a highest low, and you have a lower high. That's the recipe for the nest. Correct? Everyone, Jose, Eduardo, all you guys. Right? Now, let me see if you are a good student. If we get back to this chart over here, where are we nesting from? what are we gonna get in the S&P if we are right here? Yeah, you can watch it tomorrow again. We're gonna have the recording sometime during the weekend. I don't know tomorrow. So nesting from 3. There is too many 3. There is a 3 with double parentheses, a red and the black and the. Okay, 6. You are a member, so you're good. I know what you're talking about. It. In the worst case scenario, which is that, remember, the S&P was created over here, and this around this area was created the S&P 500, right? That's when the S&P 500 was created, as it is right now, 1957, I believe, something around here, right? So technically, if we're gonna apply the history chart, we nesting from 2009, like it's over here. We like nesting from 2009, like Fix say, right? And then look at the stochastic RSI. It goes sitting at the highs. So this thing is more bullish than what many people knows, right? This thing is more bullish. It's nesting either. It's nesting from 2009. That's a given, AJ. You can call it in the historic chart. You can call it wave 4. In the real S&P chart, the real one, which is S&P, it might be nesting from the all-time lows from the beginning, when 1998 was the end of the blue one, 2009 was the blue 2, and now it's nesting from there, and the S&P is going to explode within the next few years to the outside. Either way, it's going to explode because you have a high with divergency, and this cycle has nothing to do with this cycle. And because there is no divergency there, this cannot be your wave 4. It has to be a nest. What about that? What about that? Right. Everyone understands the two possibilities in the S&P. In the historic chart, it's nesting within the black 5. Why the black 5? Because the previous leg, it was the highest momentum. So it cannot be wave 5. Right? No, my count is right, Warman. The end result would be more or less the same, AJ. He's saying, I'm sorry, God to me, it doesn't allow to see the question. He said that what really strikes him is the end result. The end result, more or less, is the same. Why? Because in the historic chart, right here, he needs to do an extended, look at the magnitude of wave 1 with wave 3, kind of similar. The wave 5 can extend. He can see easily 7,000, 10,000 within wave 5. Because if we're going to label this wave 4 in black, guess what? If we're going to label that wave 4 in black, the next extension higher, the 1.618 or 12 in red, it comes at 667, which is almost 660. It's add a 0 at the end. It's 6670 in the S&P, which means that from there, it needs to do a 4 and a 5 in red. It will reach 7,000. From there, it will drop in a 4 in red, and it will rally in the historic chart. It rally all you want, drop and rally. You see what I mean? It's gonna reach 8,000, 9,000. in either way. You follow me? In either way. Now, if the count is the 1957, then you're going to put 0 as a watermark. It passed the 1.618. Technically, it's going to be the end result. Why? Because there is something in Elliott Wave that is called sequence that nobody uses. We developed the sequence. 5, 9, 13, 17, 21 when there is import set. So if you go to any storage chart, you got 1, 2, 3, 4, 1, 2, 3, 4, 5, 6, 7, 8, 9. It needs to do 10, 11, 12, and 13. A lot of swing to the outside. It's going to end in 13. If you go to the real chart, it goes 1, 2, 3, 4, 5. It needs to do 6, 7, 8, 9, 10, 11, 12, and 13. It's going to end about the same areas. Higher, depending which path is going to go. Because the number of swing, it will end either in 13 or 17. And so far, you only got 5. So a long way to go. Everyone understood this. This is correct. This is correct. That's, no, there is no sequence 7, 9, 13. It's 5, 9, 13, 17, 21 when it's imported. When it's correct is what makes it famous, which is 3, 7, and 11 that you guys see in social media. This is correct. I'm not afraid to say it. This is correct. That's how confident we are. 3, 7, and 11 when it's correct. 5, 9, 13 when it's imported. Right? Now, the last thing that everyone understands at this stage, to put a conclusion on it, that we're going to trade higher and that every dip is a buying opportunity. And we're going to trade higher in an extension of the historic chart, in an extension of wave 5 and black. But it's nesting since 2009 also, which is the 4 in black in the historic chart. In the real S&P chart from 1957, we are nesting from 2009. And we are nesting within the grand super cycle. So when you guys hear those boys that say, if the S&P is ending a super cycle, the world is coming to the end, look to the other side. That's how confident I am. And I hope you guys enjoy seeing someone confident, right? Depends if the RSI makes new highs. If it's the real S&P, yes, it will erase this peak. Right? If the historic chart, the RSI never going to erase this peak right here. In other words, in the historic, this is the question. If this is the real S&P, you understand that, William, right? This is for 1957, right? This one, if this is the one that the market will follow, the real one, this RSI is going to erase that peak. And that's what the nest is creating, the trap. Remember when I say early, a nest here is a trap. Why? Because you got 1, 2, 3, 4, 5. Everyone become bearish. It's a trap. You follow me? It's a trap. Everyone becomes bearish. You understand, William? And everyone see what many waivers that you see in the internet or other servers are calling the end of the grand super cycle. So in the real S&P, it's going to erase this. In the historic chart, which you have to look at it. But the point is that either way I agree. Now in the historic chart, it never should erase the peak. But either way, it's nesting from 2009. That's the point that I'm trying to make. And I know that I'm right about it. And I know that I'm right that it's going to keep going higher, higher, higher. Right? Now, so the conclusion is very simple to you guys. Don't get in the trap that the grand super cycle is ending. The grand super cycle, at least in the historic chart, you label the swings and you have 1, 2, 3, 4, 5, 6, 7, 8, and 9. But this is from here, at least if you want to be conservative, from here, you have 1, 2, 3, 4, 5, 6, 7. Imports do not end in 7. Imports ends in 9, 13, 17, 21, 25, 29. Learn that, right? Now you see how we're different, right? Now you see what you guys need to follow us in YouTube or take the trial, right? You're gonna learn a lot. We do this to the clients every single day, but in the real market. Now, we agreed that it's nesting from 2009. We agreed that we should be in wave 2 of either wave 5 and black or wave 2 of wave 3 and blue in the real S&P. I don't know what year, Dominic, we're going to reach 9,000. I don't know. Everyone understand with me, right? We got that. We got those seminars. In Elliott Wave Forecast, we got those seminars right here. And not because I want to sell to you a seminar in event. You are asking for it. You can go here. There is a bunch of seminars here. And the Ness is explaining it. Either the sequence are explaining here. Ness is selling, explaining here. The new Elliott Wave correlation and trading. A lot of stuff that we have created over the years. Right here. They are. All right. So to move on to the next topic. Because now is when it gets even more. It's interesting for some of you guys now. Now it gets more interesting. Everyone agrees right now. It's nesting from 2009. It's nesting. Either in a wave 5 and black in the historic cycle, or in the wave 3 and blue in the real S&P for 1957. It's nesting. And more upside comes, and the grand super cycle is not near to be done. Now, what does support that view? Now we're going to talk about market correlations, right? And I'm going to show you something here. This is the Hang Seng, right? This is the Hang Seng, right? The Hang Seng, the S&P is a very nice imports in the historic chart. A dream come true for a waiver in a dream come true for a waiver, right? The S&P, right? Very nice, very well defined, and on and on and on. Now, the Hang Seng, on the other hand, it was created in 1969, like 12 years later than the S&P, right? And if we go right here and we look at the Hang Seng, from the lows, right, it looks corrected. It's showing how many swings do you guys see from the lows. It's different than the S&P. It shows 1, 2, 3, 4, 5 swings, correct? Now, I doubted that there is any waiver that respects himself that is going to label this specific band here an impulse, right? Nobody sees that as an impulse, correct? So I believe that the Hang Seng is doing a diagonal, a leading diagonal. I understand that most of the waivers believe that the leading diagonals is 5-3-5-3-5-3. In other words, an impulse, but the only difference is that there is overlap in the 4 with the 1, and that's what is called a leading diagonal. In other words, something, let me see right here. I have the diagonal here. Let me see. This is what a leading diagonal looks like in the original Elliott Wave. See, 5-3-5-3, but this one overlap. We find out, no question asked. I want to ask you guys, what is the trend in the Hang Seng? Higher or lower? In your view, guys. What is the trend in the Hang Seng? Higher or lower? It's higher, right? So if it's higher there, then if it's higher there, guess what? You cannot label as an impulse, correct? Unless, because this lead in the middle, the only way that you can label as an impulse is if you label 1, 2, 1, and then the Hang Seng now, it makes a flat here, and guess what? What is that? It's a net, right? It's a net. If you're going to apply Elliott Wave. So what we get out of the Hang Seng is that it has a high, a low, a higher high, a highest low, a highest high, and a highest low. It's a sequence of 5. Every time that you see something with a sequence of 5, that makes it bullish. What do you think that the S&P is going to do with the Hang Seng in a sequence of 5? It's going to trade higher. Now, in 2007, no, I'm not going to talk about Nifty. No, I got my presentation exclusive about the presentation. The Nifty is not saying much. So if you overlay here the S&P with the Hang Seng, people don't know. But one of the reasons that the decline in the S&P happened in 2009, it was because the Hang Seng reached the blue box from 1969, right here. And that makes the decline. So if the Hang Seng is in the most bearish scenario, is nesting, this is the nest, let me put it with the right numbers, right labeling. If the Hang Seng is nesting, is doing a flat in the black too, what do you think the S&P is doing, guys? Let's be real. It's nesting also. This is the real S&P. It's nesting. Then the S&P, it might do something like this and rally. Everyone see the point? Why the grand super cycle is not ending? Now, let's remove the S&P and let's put the RSI on the Hang Seng. And what we have is also momentum divergency, and it's supporting the idea that if you have a high with divergency, that's a net in 3 waves. It's a net. That's one of the rules. We have added like 18 new rules to Elliott Wave. One of them is that the highest high in price with momentum divergency is either a flat or a net. And that's what the Nifty, like this one is showing here. So this is super bullish, and it's going to trade higher because there is 5 swing, 1, 2, 3, 4, and 5. We got the FTSE, a very interesting one. The FTSE, remember, not every index has the storage chart of the S&P. Now, the FTSE, if you look at the price action right here, the FTSE was created in 1984. So this is as real as it gets. It was created here, the FTSE, right? And the FTSE, if you look at it, it makes a nice import onto 1999. It makes a nice flat into 2009. It makes a diagonal over here with overlap. What does that mean, the overlap? That this cannot be in wave 3 from 1984. It has to be a diagonal. 1, 2, 3, 4, and 5. It's a big difference. A diagonal, like explain, a leading diagonal, like explain. And wave 3, it can never overlap in Elliott Wave. You can have 5 waves with overlap, but wave 3 cannot. And the FTSE, it makes another low, and look at the sequence. A high, a low, a high with divergency, a high is low. What do you think the FTSE is doing, AG? It's nesting. If the FTSE is nesting, what do you think the S&P is doing? It's nesting. No, it looks like no. It's nesting. I'm so sure it's nesting. I got a question for Jay. How you doing, Jay? What is in the law of 2008, just the first law of the retracement? Okay, if I get, let me copy the question to you guys. It's about the Hang Seng, right? So you're saying, why was not the law right here? Yeah, that's what I say. If I get your question, I give the possibility that this is 3, 3, and that it's gonna make 5 here. That's what you mean? That's what you mean, right? Yeah, that's a possibility. But that doesn't mean, that doesn't affect the S&P and anything. Because yeah, the S&P right here, again, it doesn't say that the S&P, if the Hang Seng does the flat, the S&P, it will extend a little bit lower within wave 2 to allow the flat. But the end result is the same. It's a nest. Right? So the point is, no, I'm going to show the 4-hour view that we have. I'm going to show you the idea is that the grand super cycle, and the name of the seminar is, the indices are in the wave 4, or they're going to rally in the nest. And I give you my opinions, right? So those are the Hang Seng and the FTSE are huge to tell you that based on them, a nest is taking place from either the grand super cycle, or in the case, if you want to use the historic chart of the S&P, like some people does, then it's going to be nesting within wave 5 and black with a lot of swings highest to come. That's the message that I'm trying to say. Now, there is a concept that we use that is called that the market run out of space, right? Last time I checked, I don't think that we're never gonna see the S&P below 0. You guys agree with me? AJ, Jay, Christopher, all you guys there. We were never going to see the S&P below zero, correct? Now, technically, the concept that we use is, and we were calling the S&P higher than here back in 2009. The moment that it took this peak, we say the S&P goes to 3,000, 2,000. Everyone was calling 200, right? And the reason why is because at that moment, we saw an airline like American Airline, and I get it. This is an stock. Every company can go out of business. So American dropped right here to around 156. It didn't allow the S&P to make the next leg. Yes, at that stage, the S&P, yeah, if you, like I say, if you are a waiver that don't use the techniques that we use, there was nothing wrong, like I say earlier, to call the S&P to do an ABC from here. But American would not allow another decline like this. So American was presenting the floor that the market has no way other to go than to go higher. Everyone understand what a concept running out of space is, right? In other words, that the stocks, remember, the S&P has 500 stocks, right? 500 stocks. One can go out of business, but not the 500, right? I can show you many now that they're saying the same. This is 2020 in American Airlines. This is the zero line. Right here, if you look at it, this is the low in American. Yeah, the transportation sector has suffered. But American, it cannot do another leg similar to this cycle ended. American cannot do another leg similar to that. So America, no matter what, is gonna hold these lows and these lows. That's why the indices won't crash. This is the transportation, the Dow Jones transportation average. Gosh, it comes from the around the 57 that S&P was created, right? 1, 2, 1, 2, 1, 2. If this is a wave 5, it has to have divergence against here. If this is a wave 3, it needs to have divergence against here. Let's see how the RSI looks like. Guys, it looks like a nest. Because still, in a nest, the RSI looks that way. It's identical to the price action. A high is high, a high is high, and the biggest momentum in the RSI is this one, right? The biggest momentum is this one. If we look at the S&P again, right? If we look at the S&P again, and we put the momentum, guess what? I want to show you something. I'm going to downgrade it here to the weekly. And I'm going to get back to 2009. Look. Because the good thing about Elliott Wave forecast is that we show you the fact, not the talking. Right? In social media, everyone is a hero. After the fact, everyone is a great waiver. Look, this is a nest. That's a nest until it breaks. Look at the RSI. You got a high, a high, a high. Right here, it did a flat. Let me make the excuse before it being asked. 1, 2, 3, 4, 5. Everyone see the 5 ways here, right? 1, 2, 3, 4, 5. So that's why you see the lowest low right here than this one. Then you see a higher high, another higher high, onto the thin, erase everything. You see how beautiful it is? Jay, AJ, Eduardo, everyone. The same is happening now. The same is happening now. Right? The same is happening now. You got a higher high, a lowest low, a higher high with divergency, a lowest low. The same is happening now. It's nesting. So American getting back, yeah, it can make a new low here, but it still is going to explode higher. This is delta. Delta has room in a fair gain. It has room because it can see 664. It has room. And this is, like I say, the transportation. You see the transportation, and when you look at it, it's impossible that it's no end. Guess why? Because you see that every high is holding, you see a high in the RSI, a low, a higher high, a low. Where to divide? This thing's gonna explode. With this year, we're gonna see a significant low about in the world indices. This year, we're going to see a significant low across the world indices. Right? And we need to be aware of that we're going to see a significant low across the indices this year. Now, everyone understands the correlation between the FTSE American, the running out of space, the running out of space, supporting the more upside in the indices, right? Everyone understand that. Any question about that idea? Very clear, right? Very clear. Now, the indices also, to throw you guys everything, they get affected by the yen. Because in order for the indices to rally, the yen needs to be weak. Now, this is the dollar yen. And the dollar yen here reached, over here, it reached 75. Right? And this is the history chart of the dollar yen. Right? I doubted that this thing is going to trade much lower. Right? So the dollar yen, sooner or later, the dollar yen, I'm going to answer those questions, Thomas, and then allow me a few seconds. The dollar yen is going to rally. And the yen, this is yen strength right here. This is yen strength or yen sideways. This is the Zerotti from Poland and a yen. And we believe that in 2011, the yen found a significant low as a group, which means that the future, the yen as a strength is running out of space also. So the moment that the yen rally, the yen pairs rally, the S&P had nothing to do to rally. So when I look at the yen pairs, right? For example, this is the S&P, And this is the yen pairs. There is a concept that we use that is called second dimension, right? First degree dimension is when they agreed in the same direction and the cycles agreed in the same direction, the overall direction in cycles and overall. For example, the Zerotti from Poland. Look at the S&P, look at the Zerotti. Right? Look at the S&P, look at the Zerotti. Identicals, right? Right there, they're trading in first degree. This period, right here, the S&P went relative sideways to higher. The Zerotti was a little bit lower. That's called second dimension. If you downgrade it, you see that they agreed in the swing. Then higher, higher, lower, lower, higher, higher. Then lower, and the S&P got sideways here. And then right here higher, and now we are in the correction. But if you have a brain, you understand how it works, the Zerotti needs to trade higher because it won't make another cycle similar to this one. So the yen weakness is gone, and the indices are nesting. And that's my conclusion. And that's the idea that I want to present to you guys. That using correlation with the FTSE, with the Hang Seng, and others that I don't want to mention, otherwise we can stay here the whole day. The indices are nesting, right? Using the concept of a correlation that the yen has ended the grand super cycle pullback, and 2011, 2012 is the beginning of another leg within the grand super cycle, which yen weakness is fuel to the indices, right? Using the concept of running out of space in the dollar yen, in the Zerotti yen, in the yen pairs, in the transportation sector. Using techniques like the RSI and the Stochastic RSI. I got no doubts in my mind that the indices are nesting, either in the story chart from a wave 4 in 2009. It doesn't matter what it is the message. If it's a wave 4 in black or if it's a wave 2 in blue, it doesn't matter. What matters here is what we do every day in Elliott Wave Forecast. It's telling members what is the right side. And the right side in the indices is very clear. It's to the outside. And the potential for a nest and a huge extension higher is just knocking on the door. And don't believe those calls for the grand super cycle to be in. Ain't gonna happen. Don't believe call for the crash. Every pullback is an opportunity. But I hope you guys understand and notice in my voice how confident I am. And I do this for hundreds and hundreds of thousands of members every single day in Elliott Wave Forecast. Right? I don't say that every chart that we draw is perfect. No, I told you at the beginning, the 1 hours are very difficult. I told our members at the end of 2021, I say 2022 is going to be very difficult. Right? Because I knew that the shopping was coming. Because the market always has a period of honeymoon and a band and a fight. Because there is two sides in the market, sellers and buyers. And when the winner doesn't, the winner always take profit. That gives fuel to the other side. The same way there is a right side and the wrong side. And the whole thing about trading is knowing the right side and what not to do. You have never seen us telling members, sell the indices. Yeah, if we see a sequence of 5 waves or 5 swing lowers, we might put an intraday sell. But we know what the right side in the indices is. And we know what the long time frames ruling are across the indices, right? So the conclusion to the answer for the beginning, I mean, the idea of the seminar, right here is, the conclusion is that looking at the historic charts of the S&P, it can be we can be nesting into a wave 5 in black, looking at instruments and indices like the FTSE that was created in 1984 and the Hansen in 1969, S&P in 1957. I see the possibility of a name. At the end of the day, it doesn't matter. It's nesting from 2009 in either both scenarios. So the logic, the critical thinking says it's going to trade higher, going to reach 7,000. God knows how high it can go, but they're going to trade higher. And I hope you guys understand this. 5,000 years ago, 6,000 years ago, we were living in the woods, right? Now we fly. Now we have electric cars. Human nature always bullish. If you want to sell one day the indices, trying to find instruments that rally when the indices sell, like buying silver, buying commodities. You have to be smart as a trader. Not always can be about the indices because you're going to be ending losing. That's the way we see it. That's the conclusion of the seminar. Now I'm going to answer some questions. I hope you guys enjoy, honestly. I'm going to answer some questions. For example, Thomas asked, what would be expected loss in the Dow S&P before the rally? Honestly, as a respect to our members, Thomas, I cannot say that to you, right? We don't know yet. We have a possibility, but we don't know yet. The market is a little too choppy at this stage. It can go different ways, but no question asked. We will know when to buy, right? The members will know when to buy. Ben, he asked kind of the same, how low the S&P can go this year. It can go, I guess, as low as it wants. It can go as low as it wants, right? I don't see it going lower than the 50% back of this area, which is around 3,500, right there. But I don't know if it doesn't have to go that low. Ben, I have more questions. Basic questions. My confusion, I thought the correlation were ABC. No, correlations are ABC in a simple 5-3-5. There is an ABC, which is a flat. It is 3, 3, and 5. Correlations sometimes are triangles. Correlations sometimes are WSY, which is 7 swings. There is many ways of correlation in Elliott Wave, right? Eduardo, I have a question for Eduardo. Great seminar, Eric. Thank you. I have to identify the nest using the Stochastic RSI. I recommend it to you what you say. Guys, we offer a trial here. Take it. You're going to learn in 14 days what maybe have taken you years to learn, honestly. No? Because selling, yeah, this is a business. But you guys can see the passion in my voice, right? I love this. So we have created all this. So you have nothing to lose. $9.99, nothing to lose, right? Another question, I don't want to miss any. William, basic question, my confusion is, I answered that one already. Let me see. Very interesting seminar. Never thought about considering the weight count from 1957. Well, I prove it to you. All the major indices, like the FTSE was created AG 1984. The Hansen was created on in 1969. S&P in 1957. Google it out. I know, make it out. In the future, which indices represent the best opportunity to outperform. It would be SPY would be the best to buy, or China or FTSE, for example. Personally, I like the Americans. I mean, I live in the States. It's the biggest economy in the world, and I like the Americans. Anyway, it doesn't matter. I think that every index, Jason, it is at the same stage. All of them, they're nesting, right? I used to be a portfolio manager. I can tell you diversify things, right? And you can buy long 10, some of the Europeans, and then you can buy dips in the Americans, the same way you can buy, because for example, things that people don't notice, but we do, because we do almost 9,000 charts every month, guys. We cover 78 instruments. And we are a group of 13 analysts, and we are hiring people, right? It's not enough. So we notice things that most people don't, due to the fact that we are in top of the market. I mean, usually the Americans, the putbacks are always more shallow than the pullback in the rest of the world, right? So you can buy, for example, NASDAQ. I love NASDAQ. It's all about technology. I love NASDAQ, and hold it forever. And you can buy the S&P in the 4-hour charts and trade that way. That's the way it is. I hope that answers your question. Do you see any correlation between the indices or yen against the Bitcoin? I see it I'm going to explain it to you. SF, that's your name right there. Bitcoin trade against the dollar. This is how it works, because it's all about correlation. Bitcoin trades against the dollar. Right? So technically, the way it works is that when the dollar gets weak, what do you think? Answer my question. When the dollar gets weak, what do you think the euro dollar will do, SF? Higher or lower? What do you think? Higher, right? Now, if the euro dollar is going to trade higher, what do you think the euro yen will do? Higher or lower, or sideways at least? It won't go lower if the euro dollar go higher. It won't go lower. You agree? It won't go lower. So the euro yen, at least, it will be sideways, right? So if the euro yen goes sideways, it's because the yen is sideways. So the indices get sideways. So eventually, when I trade Bitcoin, I don't trade based on the indices. I know how they relate at the end of the line with the indices, because if the euro dollar goes higher because the dollar goes lower, and the dollar yen goes sideways, the euro yen fly with the euro dollar, and the euro yen flying with the euro dollar means that the indices fly. And if the indices fly, the Bitcoin ETF is gonna fly. If the Bitcoin ETF is gonna fly because the dollar weakness, Bitcoin is gonna rally. I hope you see how deep we get and look at the things, right? You understand? I hope you understand it. A bunch of questions here. Will fan stocks still lead the market? I think that they are very interesting, and I think that we have the chart for them. Yeah, they are. Yeah, I think that technology is going to continue to rally, and every dip is an opportunity. And they're going to, put it this way, it's just one market, guys. If the S&P goes higher, NASDAQ go higher. If NASDAQ go higher, the technology stock goes higher. It's very simple. It doesn't have to be a. Do you have a simple product which gives intraday counts on US index? No, you have to buy at least the silver membership EA, and you get intraday counts in the indices. What are your job requirements? You have to have years of experience, at least 5 years of experience in Elliott Wave. You need to be able to write, speak proper English, and the rest pass a series of tests and interview that we do. Yeah. Can you show the Nifty? No, I won't show anything that is not part of the seminar as a respect to the membership of Elliott Wave Forecast that they pay us for the analysis of the Nifty, right? Because I didn't show the Elliott Wave counts of nothing here. Just show you other than the S&P because I have to respect our membership. But it's very simple, guys. It's very simple. I hope you guys understand it. It's very simple. $9.99 is not too much, right? $9.99. Thank you, Christopher. $9.99 is not too much. I recommend it to you guys. You guys want it. Very confident. Take the trial and open your mind, because I'm not saying that every 1 hour charge is going to work. Also, I recommend it to you guys to subscribe to our YouTube channel here, right? Subscribe to a YouTube channel. Every day you're going to get a series of videos. Every day you're going to get videos for free. Subscribe to the channel also there. Right? I got another question. Stock RSI or RSI? No, you got to use the RSI individually and the stochastic RSI together. There are two different indicators. Another question, when you start analyzing stocks, you start from the monthly all the way down. No, you start for the yearly and the century all the way down. Thank you about the presentation. I try my best. So I hope you guys enjoy it. How you guys see how confident we are and how deep we got into the market. We go very deep, guys. You guys have no idea. We got a great team here. They have breakfast, lunch, and dinner with the charts, and they love it. We offer a 24-hour support. Anytime during the day, you can ask us a question, and there's always going to be an analyst there to answer, because we believe, since I created this company, that the market is dynamic. And because the market is dynamic, I believe that we need to interact with the membership. We cannot be sending an update every 6 hours, every 4 hours. We need to tell you what is taking place. That's who we are. So thank you guys all for being here. Yeah, the video is going to be on YouTube. Subscribe there, KK. Thank you all for being here. Don't lose your money selling the indices. Is all I want to say. Thank you guys. Enjoy the rest of the day and the weekend. Thank you guys. Send the resume, Jay.